Welcome to the Yorkshire Shadow MPC, a partnership between Recognition PR, Clive Owen LLP and the York Press. Well, where do I start? It's going to be a very different discussion to the one we would have had only a couple of weeks ago. Now, UK growth stalled in January 26, according to last week's figures. Unemployment in the UK rose to its highest rate in nearly 5 years at the end of 2025. And while inflation has been falling, it stands at 3% in January. Recent events could have a significant impact. The rising oil price, $103 a barrel at point of recording this on Monday. Well, they may have a knock, undoubtedly, on many different things in the economy. What do our members think is the outcome? Short-lived pain? Or will the escalating conflict have a long-term negative impact on the UK economy? Can the Bank of England justify a cut in rates? Well, let's see what some of the members of the Yorkshire Shadow MPC make of it, including myself, and I'll give my opinions as well. But we'll start with my colleague from Clive Owen LLP, Jonathan Doyle. Jonathan, you've got a range of clients in all sorts of different sectors. What's your feedback on sentiment at the moment?
I think across all sectors, there's two big topics of conversation at the moment. And the first one is clearly the conflict in the Middle East. And people are concerned as to what the impact of the rising fuel prices are going to have on both consumers and businesses and the inflationary impact that's going to have. And the other thing that's coming up regularly at the moment is the Employment Rights Act bill. And I think the combination of these sort of global and national factors come at a time where regionally business confidence in the region was already declining. The latest data we had from the Institute was published in January, which covered up to Q4 of 2025, and that had a further reduction then to minus 15.8 on the business confidence.
And when you're out and about talking to your clients, is all the data that you're getting from the Institute of Chartered Accountants England and Wales, is all that being backed up on the ground? Are they saying similar things? Or are you seeing maybe a little bit of a spark of optimism?
The biggest thing that's being cited at the moment is the increase in the tax burden, and people are really feeling that pinch now from the increase in national insurance and also the national minimum wage. And it is remaining a challenge for clients to manage that. It's impacting on capital expenditure, it's impacting on recruitment. So there is a picture where growth plans are tending to be either paused or worst case scenario being cancelled at the moment. And you add on that extra layer of uncertainty with everything else that's going on. And I think people are concerned for the short and medium term as to what that outlook's going to be, is going to remain challenging.
Okay, Jonathan, thank you for that. Go to our other partner organisation, NewsQuest. Now, Steve, the great thing about NewsQuest and newspapers is you cover the general public, because people advertising to the general public are very much a forward indicator of what's happening in the economy. What's the sentiment like among your advertisers?
At the moment, what's been going on over the last 10 days hasn't impacted yet. Sentiment in the first 8 weeks of the year has been fairly positive. We've seen some growth across my sector, across all sectors. The Chinese car market is starting to accelerate, particularly here in Yorkshire, with more showrooms opening. Property has been fairly buoyant. And the tourism, particularly in York, has had a very strong start to the year. I think the big nervousness now is oil prices and how that's going to go, particularly into the manufacturing sectors. And we've seen that in some discretionary spend where we would get investment for things like our awards programs, which would be classed as discretionary spends. There's a little bit of reluctance to spend at the moment. There's some nervousness there.
It's very interesting. And the oil price thing, I'm sure we're going to have a vote on whether people should want to see rates go up, down, or stay the same. And then we'll ask everyone what they think. And we'll see. I'm going to be fascinated by what the dipstick survey of this group is. Thank you very much, Steve. Let's get a holistic view of the economy globally. Luke Lodge of Evelyn, you advise individuals on how to invest their wealth. Maybe they should be investing in oil. I don't know. But what's your overview?
I think from a client perspective, they've been fairly relaxed over the course of the last few weeks, from a personal perspective, with the view that it's a much bigger sort of humanitarian issue. Markets were all-time highs come 3 weeks ago, so still sitting in a positive position year to date. And I think a lot of that feeds into the fact that Trump has a bit of a track record of going back on his word and getting bored quite quickly. The Trump always chickens out. The taco trade is feeding into sentiments at the minute. But we're taking a very balanced view from that perspective, because if this does rumble on for several weeks or into several months, then the sort of fallout will be much larger.
Commodities investment's very different to stocks and shares, isn't it? If you were doing commodities as part of your portfolio, you recommend it? Do you recommend your clients have some measure of commodities so that they're protected?
Yeah, absolutely. Circa 5% across commodities, predominantly gold, and gold has been the best performing asset class over the course of the last 12 years and 12 months and beyond. So providing a great hedge against the volatility that we see at the minute.
That was a very interesting point. This is a side point. I was watching a discussion with an economist recently online who said if you bought a house, he said house prices in the last 30 years have fallen if your currency is gold. Do you contrast it to gold?
I think most assets will have fallen if the currency was gold certainly over the course of the last year or two.
Okay, thank you very much, Jonathan. I appreciate that. Let's move to Dave Broadbent from Begbie's Trainer. Begbie's looks after companies that are having a bit of a problem, tries to help them turn it round, and if not, well, it's like taking the dog to the vets. Let's have a look at you, Dave. What's your view, and how many calls are you getting?
Yeah, anyway, good afternoon, everyone. As usual, we are very busy at the moment. We are currently in the perfect storm. The main drivers we've got are twofold. One is the revenue and customs. I don't know if everybody recall, but in the last budget that was put out, they set aside quite a chunk of money to invest in the debt collection units, because I think at that point we as businesses owed His Majesty's Revenue Customs around about £60 billion. So they are now starting to recover that as best they can. Unfortunately, what that is doing is that's resonating along quite a few of the SME businesses where, to them, trying to negotiate, they're battling on all sorts of fronts at the moment. And then when you've got a field officer from the Revenue and Customs turning up, it's sometimes the final nail in the coffin. And conversely, we're also massively under the cosh with good businesses. So at the moment, not a lot of people be aware that the Revenue's business asset disposal relief level goes from 14% to 18% on the 6th of April. And I think a lot of people weren't aware of that jump. So we are hugely, hugely busy at the moment with helping businesses that have been very successful, people trying to extract the money in the most tax efficient way. So yes, a long way around of saying we are absolutely flat out. Has the Trump effect and what's going on in the Middle East had an effect on it? Yeah, I would say twofold. One is that people are keeping one eye on general costs going up. Secondly, the psychological part of it as well. I think a lot of people make a lot of knee-jerk reactions just because of some other big impact that's going on at the moment. I think we've probably got, it's a little bit like what the guys were saying earlier. It's a little bit too early to say how it will majorly impact on the smaller business market. I think the biggest one that we will see is the employment law changes that are going to take place over the next few months and on the back end of the year and early part of next year.
Yes. Can I one question I was going to ask you, actually, Dave, in my own business, and I'll give my views on the economy at the moment, but in a minute, but in my own business, I've generally managed debt quite well, clients paying and worked with them. But in the last few months, I don't know if you can tell, but I've had to take a haircut. How many of your clients and good businesses are having to take a haircut and willing to do so in order to get money in rather than put zombie businesses out to pasture?
Yeah, you're absolutely right. I think cash is king, always is. And a lot of people are saying, certainly with the smaller guys are getting squeezed,
Yeah.
and the bigger corporations, it happens whether we're in a recession or not. It's the way in which the bigger people manage their own cash is to dribble it down. And unfortunately, you're absolutely right. The smaller guys are having to take, and the problem is you've got people like the Revenue and Customs who just don't do deals, conversely.
Yeah.
So from their perspective, they are now, our understanding is that they're giving 6 to 12 months time for people to pay debts that they may have accrued over the last couple of years. So yeah, you're absolutely right.
Yeah, it's happening all the time. Personally, I don't like doing it. I have some sympathy, but I think if you're in business, you've got to pay your bills. Right, Becky, what's your view on what I've just said there?
Well, I think that the work that's going on the prompt payment code is therefore very important in that sense. So I think we've just done our update to government on the short-term, medium-term, long-term impacts. I think from a short-term perspective, lots and lots of businesses are in wait-and-see mode. There are some who obviously buy gas and fuel on the spot market, and they are obviously being impacted significantly. And we're seeing others just learning the lessons from the Ukraine crisis, the Syrian crisis, and how they're thinking about sort of doing a little bit of forward purchasing, making sure that they've got the raw materials coming the right routes, either from China or looking at other alternative suppliers in that sense. I think in the medium term, it is all about duration and the impact, therefore, on the inflation rate. So if it goes beyond March and you start to see physical damage of sort of oil storage, gas storage, more impact to the Strait of Hormuz, then you really start to see that sort of more consistent rise in the oil barrel price. So, it consistently stays above 100 rather than coming down to between 80 and 90. So I think
I did actually see an analysis in the weekend papers, I think it was in the Sunday Times, that was pointing out that although we're getting very alarmed at 100, and clearly it is inflationary, there's no question, it's a serious issue. When it was last at its peak in 2008 for a prolonged period, it was, when you add inflation, the equivalent of 200.
Mm-hmm.
So it's bad at 100, but it's not the worst. That's me for optimism, folks. That's all I've got.
And I think at its height in the Ukraine crisis, it was around 145. Yeah. I think we're taking into consideration that obviously the Ukraine crisis started in February, and we didn't see peak oil price hit until June. So I think there's just a lot of sort of we're seeing people from, there is good sort of storage levels, the big sort of power generators and distributors seem fairly sort of relaxed at the moment, but they're keeping a very close watching brief.
All right, look, geopolitics and geoeconomics clearly at the front of mind of all businesses now, Becky. We're going to go and do our vote in a moment, but let's just need to catch up with Richard. Richard from Helmsley Group into property development, and Carrie in a moment as well. Let's pick on Richard first. Okay, so how are you renting out? Have you got bad debts? Is there
how are we finding things? I went into the start of 26 a bit more sort of positive, if I'm honest with you. It was a dire end to 25 as far as I was concerned. As Dave mentioned, part of our business is lending money to other developers, and we'd unfortunately had to put LPA receivers into place on a couple of them, which I very rarely had to do in the past. So that was sort of symptomatic of a difficult market, things not quite selling, bill cost inflation. But then the start of 26 was very good, if I'm honest with you. My broker inquiries in terms of finance deals were going off the charts. I was putting more indicative offers out there of funding support to more and more developers around the country. The colleagues of mine that look after our lettings division on the commercial agency side of things, they were very busy. There are lots of, certainly in the York area, lots of the big national companies wanting to have retail and leisure coverage in the city centre again. So starting to be quite positive. Houses were selling, the market was waking up a little bit earlier than we were expecting it to. You normally wait until around now with the daffodils coming out for people to sort of start to coming out from underneath their duvets and seeing what's there. So I was positive, but where we are now and what's happened in the last couple of weeks, I think it's just slammed the brakes on. I think at the moment people are just waiting and seeing. I'm still getting inquiries, but there's a bit of nervousness around the market in general at the moment on that side. So positive start, but yeah, brakes on just at the moment. And is it going to be a 4 to 6 weeks, or is it a 4 to 6 months, or more? Who knows with Donald in charge? So.
Thank you, Richard. Kerry, let's bring you in from Castle Employment. Are you getting more inquiries of vacancies, or are you overwhelmed with candidates and no jobs?
Well, we only recruit into the engineering and manufacturing sector. This is really sector specific, and it's very much job led. So hiring is happening, but with much more caution, and clients are much more focused on productivity, cost control, things like what Jonathan said about the employment rights before they're even considering recruitment. So just like what's been said, confidence was really starting to increase. I would say December, January, February, and it's, we've just had some paused vacancies over the last 2 weeks to say, let's just see where things are. So it's just like everybody else is saying, inconsistent. There isn't the confidence, and people are just, unless it's a critical hire, they're certainly not hiring if it's growth at this stage.
Kerry, forgive me if I've made this, got this wrong, but I think the Employment Rights Act, which a couple of people have mentioned today, doesn't kick in until January. Is that right, or is it April?
No, there's quite a lot changing from April in line with the national living wage going up as well. So yeah, there's lots of changes around.
April, but the actual act with the more the rights and the sick pay is later.
April.
Okay. No, you corrected me. I'm perfectly happy. I'm just a cocky PR man. You're in charge of your business. You know best. Okay, well, we've heard from everybody now. But no, we haven't heard from me. I take Richard's view. Sentiment was getting better for my business in January, and actually in the last few weeks until this period. My business serves 70 clients with a turnover of 8 billion, employ about 45,000 between them, my clients. But a lot of them have made some serious job losses. I was topping them up. It's in the thousands, not in the hundreds, the job losses at my clients. So, but they were ready to get through it. They'd done their job losses. They were ready to get on, promote their products, get out and about into the marketplace. They're still keen to do so because they have to. But I think I share everyone's view on the downbeat sentiment we've got today. Right, so by show of hands, let's see what we should do on rates. Don't forget, the guiding principle is inflation. Inflation at 2% is the target of the Bank of England. That's what if you're on the real MPC, that's what you're supposed to think about. So the question is, if you were on the real MPC this week, would you vote to put rates up or keep them the same or lower them? First, anyone would vote to lower rates, please. Hands up. 1. Next, who would vote to raise rates? None. Although there are some commentators talking about potential raise later in the year. And who would vote to keep them the same? Okay, so let's go around and just have a quick view on the key, just very quickly, 10 seconds on that vote. I'll give you my view. I voted to keep them the same. I think, having said that, we may have to put them up in a few months, because the government is not causing inflation to diminish. It's still spending lots of money. It's not tackled things like welfare. It's not tackling, in fact, some of its taxes are inflationary, like air passenger duty, and later in the year, if it goes through with it, fuel duty. So really the only policy making that can grip inflation is money supply, and I want to hold it or even put it up at a later stage. That's my view. I'll come to you in a minute, Kerry. I'll put you in the middle. Let's hear from Luke. Luke, why were you a holder?
Due to the energy-related sort of inflation currently might be masking broader disinflation in the wider market. Hopefully, the inflation on energy prices is transitory, and we start to see the position settle over the coming months. So that's the view as to hold. The sort of broader UK economy is fragile at the minute, with the cooling labour market. So in an ideal world, we would like to be bringing rates down, not taking them up.
Yeah. By the way, what's your view if it does get worse that we'll have to go up? There's not a shoo-in that they're going down, is it?
It's not a shoo-in, no, because it'd be a similar situation to the fallout from Russia-Ukraine. We've had this playbook in the quite recent times.
All right, Steve, you went to hold. Your main point?
Yeah, sentiment really. I think people are nervous. I think we don't want to scare people away at the minute from investing, looking forward. I think if we put the rates up, people will batten down the hatches even further, and I don't think the economy can afford for people to do that.
Dave, your reason?
Yeah, I completely agree with everybody. It's too much uncertainty at the moment. I think we've just got to find out what's going to happen in the next couple of months. But I'm with you, to be honest. I think the only way in which they can combat it is look at an increase 3-4 months down the line, unfortunately.
Terry, let's hear from you. Just because you're a dissenter doesn't mean you're wrong. You can be in the minority and be right. What's your reason for wanting a cut?
Just a slight reduction, I just think would help with businesses thinking about investment and offer some more stability and predictability, really. So
I suppose the other thing about money supply, inflation being caused by too much money in the economy, is that if you are going to have big increases in petrol, whilst at the first round they are inflationary, they are also taking money out of the economy. So there is an argument there. All right, Kerry, thank you. Becky?
I voted to hold because inflation really could have a sort of quite serious impact. We think that higher oil prices could have a 0.5 percentage point increase onto the inflation rate. So that's the thing that really is going to be driving their decision making.
Richard, I suppose you are really the turkey that votes for Christmas, because your personal profession is better if they went down, but you've taken a bigger view. What's your reason?
To be fair, you summed it up really. Mine was a reluctant hold. I would have preferred to have voted for a drop to try and kickstart the property market. But now is just not the time. I think we've just got to see where we are, keep everything on hold as it is at the moment, and wait and see what the next few months transpires for everyone.
Okay, and Jonathan, you get the last word.
I'd describe it as a cautious hold at the moment. I think we're going to have to see how this sort of plays out. I think obviously there was an expectation that we'd hopefully be talking about rates coming down before all of this happened, but unfortunately I think we might have to prepare ourselves for the fact that they may need to go up again at some point in the future as well.
All right. Well, there we are. A bit of a sober and depressing shadow MPC. Sorry about that, folks. We'll just have to smile as we go through all this, and we'll see you next time with the Yorkshire Shadow MPC.